Fixed assets and asset disposal in the balance sheet. According to the prudence concept, non-current assets must be shown at a realistic value in the financial statements. Non-current assets are therefore shown at carrying value on the face of the balance sheet. In the note for fixed assets, in other words, note number 3, the original cost price is shown in order to also comply with the historical cost concept. So if a non-current asset is sold, it is subtracted at carrying value in the note of the fixed assets. The cost price of the sold asset is subtracted from the cost price at the beginning of the year, and the total sum of the accumulated depreciation of previous years is subtracted from the balance of the accumulated depreciation at the beginning of the year. The extra amount that is written off for depreciation, if the asset was sold during the financial year, will be included in the amount for depreciation for the current year and will therefore be cancelled by subtracting the carrying value of the sold asset. Let's look at an example together so that this can be more clear to you. Example number 5. The information was obtained from Park Stores for the financial year ending 28 February 2018. Required. Number 1. Complete the accounts provided in the general ledger of Park Stores for the financial year ending 28 February 2018. Number 2. Complete the balance sheet note for fixed assets on the 28th of February 2018. Let's look at the information together. So on the 1st of March 2017, the following balances appeared in the general ledger. Land and buildings, vehicle equipment, accumulated depreciation on vehicles and equipment. So let's take that information and take it to our financial statements and ledger accounts. So in the ledger accounts, land and buildings, vehicles and equipment, all of them are assets, so therefore the balances goes on to the debit side of the account every time. So balance brought down for land and buildings, 1.35 million. On March 1st, balance brought down for vehicles, 780,000, and then for equipment, balance brought down, 340,000. Then for the accumulated depreciations on vehicles and on equipment, remember that both of those are known as negative assets. So that's why I would go and I write an asset but then circle the negative side. That's just to remind myself that they favor the negative side of the account. In other words, when I increase the account, this would actually happen on the negative side of the account. So therefore the balance brought down is also then added onto the negative side of the account. So balance brought down for vehicles, 169,000, and then for accumulated depreciation on equipment, balance brought down 65,800. Then in your financial statements, note number 3, your fixed assets note, you would also write these balances at the beginning of the year, and then accumulated balances also, and then total them up to the last column. Now just out of interest sake or just for clarity's sake, remember that your fixed asset note is divided into 3 terms or 3 stages within your year. First stage being the beginning of the year. So this is all the information as it would be beginning of the year. Then your movement is as explaining what would happen during the year. So what has changed during the year? You added, you disposed, or you simply used it and therefore you depreciated. And then the last bit of the note is your carrying value at the end of the year. So it summarizes all the information as it should be at the end of the year. So the carrying value beginning of the year, remember, is simply a calculation between your cost minus your accumulated. Please remember that accumulated, due to it being a negative asset, has to be in brackets every time. Okay, you're going to lose out on marks if you forget the brackets. Land and buildings doesn't have any accumulated, therefore carrying value is 1.35 million. Vehicles, you take the 780 minus the 1690, and then you get your 611,000 carrying value. For equipment, 340 minus the 65,800 leaves you with 274,200, and then your total of 2.47 million minus the 234,800 leaves you with 2,235,200. That's then as your information would be beginning of the year. Let's go back and look at the rest of the information to have some clarity on the movements. Now the rest of the information explains to you everything that happened during the year. So what I want you to do is I want you to follow with me on this page. I, however, am going to draw up this information or complete it by completing it on the timeline. So let's see if we can complete all the information on the timeline. So from the 1st of March, beginning of the year, up to the 28th of February, I started my year with these balances, and then we're going to change them to see what our balances would look like at the end of the year. So for me to have a clearer indication of that, I'm going to start with number 3. They say on the 1st of March 2017, new equipment was bought on credit for 212,000. So 1st of May, that's somewhere here. So 1st of May, I bought new equipment. So I added 212,000 to my equipment. So what I'm going to do, my balance at the end of the year, I'm going to change it and just say, remember there needs to be an adding of 212,000 Rand. Then something else that I need to remember is, remember this is now a new asset that I've bought and I will start using it as of the 1st of May. So therefore I must remember that I need to write off depreciation on this asset, and I need to write off depreciation as of the 1st of May. So from the beginning of May up to the end of February, so that gives me 10 months that I need to remember to depreciate this new asset for. Information number 4. They say on the 30th of September a new building was bought for 670,000 and paid for by check. So somewhere here on the 30th of September we had a new land and buildings, and that new land and buildings is an added 670,000 Rand. So what I need to remember is I need to update my balance at the end of the year, will then increase with 670,000 Rand. Now because there's no depreciation on land and buildings, I don't need to remember anything of how long I had it or used it. It doesn't lose value or depreciate, so therefore I can leave it like that. Now for adjustment number 5, or information number 5. On the 30th of November 2017, the old delivery truck of the business was traded in on a new vehicle. So remember, a trade-in happens that if there's a trade-in, there has to be a new vehicle bought, because the new vehicle that I buy, the old one is basically given as a deposit on the new one I'm buying. So a trade-in on the 30th of November tells me that there's an asset disposal as well as a new vehicle bought. So two things happening. So the delivery truck was bought on the 1st of July for 348,000. It was traded in for 220,000, and the cost price of the new vehicle was 318. So we added 318 new vehicle, and then we need to do a calculation for the old one that we sold. Now remember, at the disposal you need to go and draw up that little table of yours. So we fill in what we can on our little table. They said that the new vehicle, or the one that we sold rather, was bought for 348,000. They don't tell us anything about the accumulated, but we know that we need to have two amounts, an old amount as well as a new amount. Then they said we traded it in for a selling price of 220,000. Now, because they don't give us any information regarding the accumulated depreciation, but they do, however, tell us the date on which we bought this in the first place, then we know that we can go and plot exactly how long we had this asset for, and therefore go and calculate the accumulated depreciation on our own. So let's go and plot exactly how long we had. So we bought it on the 1st of July 2013. So that was there, 1st of July, and that's when it was bought. So in other words, in that first year, we had it for a total of 8 months. Then we had it for a full year, up to where we've now sold it, and that is on the 30th of November. So in the last year, we had it for only 9 months. For the first year, we only had it for 8 months, but then we had it in between that for 3 full years. So we can go and calculate that. And when we go and calculate that, we can see that for the first year, it was then 23,200. Remember, it's on the fixed method, fixed installment method. So I take my cost price times 10% every time, 10%, 10%, 10%, and then it's just my months that differ. So for the first year, it was 8 months, so that gives me 23,200. For year 2, year 3, and year 4, it was all for full years, so therefore my depreciation will be the same, 34,800. And then it's only the last year where I again had it only for 9 months, and that is then 26,100. So therefore, if I calculate all the depreciation on this vehicle that I'm selling before this year, it gives me a total of 127,600. Then this year I still need to depreciate it further for 26,100. Now, please just remember this 127,600, that amount is included in my balance for vehicles of 169,000. So that amount is already being recorded and it's in my opening balance. The amount of 26,100, however, is not included yet. I must first go and record that so that I can take it out again through the asset disposal process. So what I need to do, I need to update my table here. And when I update my table, 127,600 previous years together with this year, 26,100, gives me the total accumulated depreciation. Then to work out my carrying value, I will take my cost minus all of my accumulated depreciation, and that gives me a carrying value of 194,300. So I take that, compare that to my selling price of 220,000, and I can clearly see that that was what it was worth to me in my books, and I sold it for more than that. Therefore, I have definitely made a profit. It's going to give me a negative answer, however, 25,700, but that points towards a profit on sale of asset for this vehicle that I'm selling. Now remember to record this in my books, the asset disposal. There's 5 steps to follow. Step number 1 is to record the new depreciation and add it to accumulated depreciation and to depreciation. Then I start with step number 2, 3, 4, and 5. And 2, 3, 4, and 5 all has the contra accounts in asset disposal. So step number 2 is to take out your cost price out of your vehicle's account and move it to asset disposal. Step number 3, to take out accumulated depreciation and move it to asset disposal. Step number 4, to record the trade in and move it to asset disposal. And then also step number 5 is to close off asset disposal and create an account by the name of profit on sale of asset. You're going to do that. just to update our balances, let's just quickly record that. So in other words, my vehicles balance, first of all, needs to decrease with the 348,000, but then it also needs to increase with the new vehicle that I'm buying, and the new vehicle's cost is 318,000. In terms of accumulated depreciation, for now, we can only see that we added to accumulated depreciation the 26,100. And remember, due to the asset disposal, we're going to also subtract the total amount of 153,700. Then the last thing for us to consider is that we bought a new vehicle on the 30th of November. So therefore, we had that for December, January and February. So that's 3 months worth of depreciation that we also need to write off for that. And then the very last thing to consider is at the end of the year, I have depreciation to consider. And remember, we've already said that we need to consider depreciation on the new equipment that we bought and then the new vehicle that we bought. But don't forget that you have equipment from the beginning of the year that also needs to be considered, as well as you have vehicles from the beginning of the year that you also need to consider in terms of your depreciation at the end of the year. So let's go from the beginning of the year and work it through systematically until we get to the end of the year, so we won't forget any information in our accounts. So the first thing for us to do is to record that we bought the equipment. So in our equipment account, we're going to say that on May 1st, we bought on credit new equipment. So creditors control CJ would be the journal used. And we bought 212,000 Rand worth of new equipment. That brings our equipment balance to 552,000 Rand. We can take this information then to our note 3 as well. In terms of equipment, we bought new equipment, so we're going to add it to the additions at cost. So additions at cost for equipment, we added 212,000 Rand worth of additions at cost. Now remember, what did we do with those additions? We took our cost beginning plus the additions, and that gave us the cost at the end of the year. So keep that in mind. We're going to update that records in a little bit. The next thing in our timeline that happened was on the 30th of September, we had new land and buildings that we bought. So in land and buildings, we're going to update our records. September 30th, we bought it for cash. So the CPJ would have been used 670,000. That brings our land and buildings to a new amount of 2.02 million Rand. If we update our note 3, we're also going to say there was additions at cost 670,000. That's the only movement for the year for land and buildings. That means that our cost is now increased to 2.02 million. That brings our carrying value to the same value for land and buildings. Then the big one, the 30th of November, there was a buying and a selling all on one day. Let's consider the buying first. That's the easier one. So we bought that new vehicle on the 30th of November, therefore increasing our vehicles. So 30th of November, we increased it with a trade-in. Now remember, a trade-in, again, is reliant on selling and then buying a new one. So the new one that I'm buying is always then regarded as buying it on credit. So therefore, all of this, a trade-in is always going to go through the creditor's journal, CJ, and that is 318,000 that I'm adding onto my vehicles account. Now, the disposal of the asset. Remember, there's 5 steps. I need to record all 5 steps for me to be finished with this transaction. So let's start with step number 1. And step number 1 says, I bring into account the depreciation for this year. So for those extra 9 months that I still used the asset before I sold it, I need to depreciate it. So therefore, I'm going to record the depreciation as an increase in accumulated depreciation on the credit side. November 30th, depreciation will increase due to the General Journal 26,100. So then also in the depreciation account, I will say on November 30th, going to accumulated depreciation on vehicle, the General Journal was used 26,100. That is step number 1 that I'm now done with. Step number 2 is then to record the taking out of the vehicle out of the vehicle's account and moving it to asset disposal. So I need to decrease my vehicles account, therefore I'm going to put it on the credit side of vehicles to show that I'm taking this vehicle out. Now remember, this vehicle that I'm taking out at the moment is part of my opening balance, right? So I want to remove it from my opening balance, so therefore I need to put it on the opposite side. That's a credit entry. So on November 30th, I'm going to move it to asset disposal. That's the 348,000 Rand. And that's step number 2. Step number 2, this credit has then a debit in asset disposal. So in asset disposal, I'm going to say November 30th coming from vehicles is the amount of 348,000 Rand that I'm moving into asset disposal. Step number 3 then is to remove the accumulated depreciation amount. Now remember, some of the accumulated I'm going to take out is now actually forming part of the 169,000, and that's the 127,600 coming from the previous year's worth of depreciation. So that's present in the balance. Then I added the 26,100, therefore I can now take it out. So I can take some of the money out of the balance and I can take the 26,100 out again to remove everything that has to do with this asset from my accumulated depreciation account. So therefore I'm going to remove it. I'm going to say November 30th, I'm removing it and taking it to asset disposal. The total amount of 153,700. Step number 3. So step number 3 has its credit in asset disposal. I'm going to say November 30th, accumulated depreciation on vehicles has the amount of 153,700. Step number 3, done. Then step number 4, the creditors control. The trade-in needs to be put into my book. So I'm going to decrease creditors control on the debit side, therefore bringing it to the credit side in asset disposal through the General Journal, and that's 220,000 that I'm recording for the selling price of it. Then I add up debit side, I add up my credit side, and I see my credit side is greater than my debit side. Therefore, the credit side's amount, the 373,700, becomes my balancing figure on the debit side as well. Very important, guys. Don't forget that asset disposal is a calculation account. Therefore, as soon as I'm done with my 5 steps, I need to be done with this account as well. Meaning that this account can't be open, I need to close it off. So the final step, step number 5, needs to close off this account. So it's closing off due to credit side at the moment is on 373,700. I need to bring my debit side to that same amount, and I can only do that by adding in the 25,700. And that 25,700 is going to be taken to the profit on sale of asset account or profit on disposal of asset account. And that then is step number 5. So the profit on sale of asset account will be credited. And remember, when I credit an owner's equity account, it means that I'm actually creating an income. Therefore, profit on sale of asset is an income in the books of the business. And then I'm done with it in terms of in my general ledger. Now let's complete all of that information in terms of note number 3. So firstly, I need to show that I am adding 318,000. Then disposals on carrying value. I need to show it at carrying value. Therefore, it means that I took the cost minus the total accumulated, and I therefore only use the carrying value of 194,300 in my note 3. Then the depreciation we're going to still need to calculate, because remember this, we've only now calculated depreciation for the sold. We need to still calculate the depreciation for the new, as well as that the vehicles and equipment that we had for the entire year. So let's go and calculate that. So for equipment, there's two calculations needed for depreciation. I had equipment for the entire year. So therefore, because it's at carrying value, I need to take the cost minus the accumulated thus far. I times it by my 15% depreciation rate, and I had it for the entire year, so 12 over 12. That gives me depreciation for the used for the full year. I lost the value of 41,130. Then for the new equipment that I only bought on the 1st of May, remember I bought it for 212,000. It's minus nothing because I haven't lost any value on it thus far, times 15% depreciation rate, and I had it for a total of 10 months. Therefore, it lost a total value of 26,500. So my depreciation for equipment for the year is 67,630. So even though I had to calculate it separately, when it goes into my books now, because it's all going in on the 28th of February 2018, on the same day, I need to put it in as one amount. I can't put through two entries on the same day. We're going to do that now. Let's just calculate vehicles as well. So the vehicles that I used for the entire year, remember I need to just keep track of the vehicles that I've sold. So I started the year with 780. Then I subtracted the 348,000, and that's going to tell me how much I had for the rest of the year before I bought the new one. So in other words, the 780 minus the 348 tells me that I actually had 432,000 rands worth of vehicles that I used then for the entire year. I times that by my 10%. I times it by 12 over 12 because I had it for a full year. So that gives me 43,200 loss on value for that vehicle. Then the new vehicles that I bought on the 30th of November was the 318. Still 10%, but I only had it for 3 months. So 3 over 12. And that gives me 7,950. Again, because both of these depreciations will be written off on the 28th of February, I need to add these two amounts together. So it gives me 51,150 that I need to depreciate on vehicles further. So firstly, the depreciation on vehicles. On the 28th of February, depreciation, those two amounts added together, the old and the new, gives me a total of 51,150 that I'm adding onto my accumulated depreciation account. Then for equipment, depreciation, the two amounts that I'm adding together gives me 67,630. So in my depreciation account, I'm going to say that vehicles increased my depreciation account with 51,150. Equipment increased my account with 67,360. So in total for this year, the total amount of depreciation for the year then was 144,880. And remember, this is an expense account. So therefore, all expenses are closed off at the end of the year to the profit and loss account. Now, this is just a tip, very important tip that I can give you here. This is the total amount of depreciation then for the year. Therefore, if I go to my note number 3, the total amount of depreciation then for the year, as seen in note number 3, should be the same amount. of 144,880. So that's a way for you to test yourself that you've done note number 3 correctly. That total there should correspond with the total I've got going to profit and loss account or going to my income statement. Should be the same. Another way to test yourself is to now complete this note and then test if you calculate from the top downwards or from the bottom upwards. This carrying value amount that you calculate should in both cases calculate to the same value. Now if we fill in depreciation in our note as well, the only thing that you need to watch out for is the vehicles one. Now remember we had two amounts that we depreciated in this year. The one was on November 30th and the other one was at the end of the year. So both of these amounts together gives me the total depreciation for vehicles that needs to go to note number 3. So I'm going to add the 26,100 plus the 51,150 and it's going to give me 77,250 that I need to take to my note number 3. Then I also bring into account the total amount for equipment, and that then gives me the total movements for the year calculated as such. Let's finish off the rest of our accounts then. Our vehicles account, if we balance out that account, we're going to see that we have a balance carried down of 750 Rand for the year. Accumulated depreciation on vehicles, we have a balance carried down then of 92,550. And in equipment, we add it up, we get a balance of 133,430. So these then becomes the balances that we need to take to note number 3 as well. So the 202 is in note number 3 already, the 2020. Then the 750 and the 552 should be the final balances in terms of our cost at the end of the year for vehicles and for equipment. And then the balances coming from the accumulated accounts should then be the 92,550 and the 133,430 should be there as well. And then we just add it up sideways to get our total balance there. Now, to get the carrying value at the end of the year, we take the cost minus the accumulated, and that gives you the carrying value. Take the cost minus the accumulated, and that gives you the carrying value. I add up all three of my carrying values to give me my total amount in the total column. And this total amount in the total column, that is then the amount that I'm after. That's the amount that I want to take to my actual balance sheet as my total amount for my fixed assets for the year. Now, if you understood how to complete note number 3 by using the actual accounts to complete it, then you should also be able to complete it without the accounts. So let's just recap. If we, for instance, take the vehicles, which is now the most complete column that you can get in note number 3. Vehicles, basically the whole column of vehicles consists of two accounts. It consists of the vehicles account, which is also known as the cost account, and it consists of the accumulated depreciation account. And then the difference between the vehicles and the accumulated is that's going to give you the carrying value. So let's recap on how to calculate it without actually seeing the T accounts or the general ledger accounts. So if we take the two accounts and just highlight the information, the cost at the beginning will be seen in vehicles. Then to that cost we added any additions and we subtracted the cost of the disposal, and then that leaves us with the cost at the end of the year. So therefore the cost at the beginning added with the additions, subtracting the disposal, the cost price of the disposal, that leaves you with the cost at the end. Okay? Then to find the accumulated balance, I started the year with an accumulated beginning balance. I then added to that balance depreciation for the year, and I subtracted from the balance any disposals. That leaves me then with the accumulated depreciation at the end of the year. Therefore, beginning balance plus depreciation minus your disposal, accumulated value due to disposal, leaves me with the balance at the end of the year. So exactly the steps that we followed to complete the general ledger accounts, those are the amounts that needs to be added together in the note as well to give me the final amounts in the notes that I need. Then to find the carrying value in the note, it's simply a calculation between cost minus accumulated. I hope that this is clear to you and that you are well aware of how to complete this note. This is obviously a very important note for you to be able to do, as this will be frequently asked in the questions that follows, as well as in tests or exams. The last thing that I see that we left out, profit on sale of asset, is also then closed off at the end of the year due to it being an income account, closes off to profit and loss account as an income for the business.